back. You're watching The Money Show on ET Now. So let's keep it with the theme of retirement and talk about the one instrument where almost all of us, and more particularly salaried individuals, do deposit a part of our salary into this instrument. It's called the EPFO, or the Employees Provident Fund Organisation. A part of your salary is deducted and cut into the Provident Fund account, and your employer as well contributes. This year's interest rate was fixed at 8.5%. However, if you've been watching ET Now, you'll know that you're not going to get the entire 8.5% interest at one go. You're going to get it in parts. 8.15% now and 0.35% later, probably before the end of this year, roughly by December. So what does it mean? Has this entire market crash hit EPFO as well? Does that render your nest egg to succumbing to this market crash? Let's talk about this and more with Jitendra Solanki. Mr. Solanki, really appreciate you joining us today on ET Now. So let's first understand, the EPFO, how it works. When I am putting a little bit of my salary into the Provident Fund account, in my Provident Fund account, where is the EPFO in turn investing this money?
Okay, in previous invested debt instrument, and they have also fixed term which you get from Employees Provident Fund account. Last 2 years, provision has been made where the 50% of the surplus EPFO can invest into equity, and look at the current exposure. The EPFO has been investing in exchange traded fund, EPF, and
Okay, you know what? We're just going to try and reconnect with Mr. Solanki. We've caught him on a bit of a bad line. But yeah, just to refresh the memory of our viewers, what exactly has happened is that perhaps, it was not just the equity markets that's played its bit. Remember that a lot of individuals were also facing cash crunch because, they as well either unfortunately may have been laid off because of the crisis, or they may not have received their salary. So in order to stave themselves off any sort of cash crunch problem, they started withdrawing from the Provident Fund. The finance minister as well did allow a few higher withdrawals from the EPFO, from the PF account. So that's what's happened. In fact, yesterday as well, in a parliamentary Q&A question, there was the announcement made that there has been a massive 39,400 crore rupees withdrawn from the EPFO during the lockdown. So that, coupled with the market crash, has also hit the EPFO, which has decided thus to split the credit to the account holders and to the subscribers of the EPFO into two parts. So 8.15% and the remainder 0.35%, but that too is subject to, of course, how it's being able to sell off the equity portion where the EPFO does invest your money in. So it's clearly the economic duress due to COVID-19 that seems to be hitting the EPFO as well. By the way, this 8.5% interest that has been declared for FY 2020 is already the lowest since, I think, 2013. Last year's interest as well was roughly at about 8.6 or 8.55%, but this year was excuse me, it was kept at 8.5%. So just to essentially understand that how the EPFO is investing money, and what exactly has caused the EPFO as well to come under this kind of duress, which is prompting them to sort of try and break up the credit that you should be getting in your EPFO account. That's, I guess, this is one strategy that is being deployed by EPFO. But remember, you are going to get your money. It's not something to be worried about. Okay, Mr. Solanki, we were just talking about where does the EPFO invest, our money that we are putting in our accounts. If you could just continue with your points.
Okay. So what happens is EPFO, Employer Provident Fund, now can invest as per the provision 15% of the surplus into equities, and that's where the return variability is coming. Now this 15% largely is being deployed into exchange traded funds, SBI, UTI, and there are other ETFs where EPFO has been investing. So what happens is that when EPFO invests 15% of the surplus into equities, portion of your employee provident fund account or balance or your contribution actually earn a variable return. And that's where this difference of credit of EPFO interest into two portions has been happening. Because the last year return, EPFO has earned negative returns on ETF. And this is how it is going to happen. The ETF markets produce variable returns. And the last year return has been negative. And that's where the difference in your EPF interest is coming in. That your returns, the portion of your returns is variable now because portion of your EPF contribution, portion of your surplus is invested into equities market.
So Solanki, then should EPFO subscribers be a little worried? Because the other reason as well, at least what's being talked about is also the fact that there were too many withdrawals, well, India did cope with the coronavirus and the layoffs, etc. So, we unfortunately did have to starve off this cash crunch, and hence we resorted to the EPFO. The finance minister as well did allow, right, for a brief period for individuals to withdraw money from their PF account in case of an emergency. And this is sort of very reminiscent of something that happened with a mutual fund house. There were too many redemptions, and the mutual fund house said that, look, I'm going to stop redemptions. So that's the reason why maybe a lot of viewers as well could be a little worried. Do you think this thinking is right, or do you think that there's no reason to worry as such and that our nest egg is fine?
No, I think, it's not a worried point for subscribers because as of now, the limit has been subscribed to 15%. So it's only 15% a portion of your investment which is getting variable returns. And if you look at still 8.5% EPFO interest have announced. And from that 8.15% is credited immediately. The 0.35%, which is largely the part of that variable return, is going to be credited later. I don't think, it is a matter of worrisome for subscribers because the large portion of employee provident fund corpus is still invested into debt. And that's where the returns, the fixed return is going to be earned. So I don't think, that's a worried point for investors or subscribers of EPFO. The good point, in fact, it is that if there are negative returns, there are going to be good positive returns, and that's where you might be able to earn a better return than even 8.5%.
Anki, what happens if, a subscriber wants to withdraw her corpus from EPF before December? Will they have to contend with this 8.15% interest?
See, yes, because the 0.35% is going to be credited in December. It is in two portions. Okay, so the day you are invested, and if you are withdrawing the money, then you lose portion of that interest. Though it is 8.5% is announced, but if you are going to withdraw the money completely before December, then you end up losing the part of that interest which is going to be credited in December. So I think. When the interest rate has been announced, the investors should stay invested till December to get credit of that interest into their account.
Okay. You mentioned about how the EPFO is using ETFs, and maybe it's a sensible move, obviously, right? Because the whole fund manager risk is sort of obviated, and ETFs tend to have less volatility as well. But then, you face a little scary problem like this. So, if I have to put my money in, in a provident fund, would I be better off perhaps saying that, look, I will, manage my, this fund that I'm putting aside. Instead of putting in a PF, I'll manage it myself. I myself will put it directly into an ETF, of my choice and maybe in, and across other fixed income assets as well. I mean, would you recommend then that individuals perhaps get a little more savvy with respect to managing their nest egg that's basically put aside in this PF?
Well, let's look at EPF advantages. The first advantage is that the EPF contribution, the equivalent amount of contribution is coming from your employer. Now, that's an additional amount of investment you are receiving. The second advantage is that these are compounding returns. The returns are getting compounded. So, if you have invested for a very long period, you'll probably end up earning a good corpus. Now, because of and the interest is coming to you tax exempted. Now, because of these advantages, I think a portion of your retirement corpus should always be invested into EPF. And as I said, it is 15% of the entire surplus. Now, 15% of
Okay. Just one quick question. I wanted to know your view on the PFRDA launching this minimum assured return pension scheme for retail investors. I'm not sure if you've read through it, but when you say something like minimum assured return, it definitely does turn a lot of eyeballs. What's your view of that?
See, any investment product giving investors any kind of minimum assurance of minimum fixed return is surely going to attract a lot of investors, especially in the current scenarios when we see the fixed return investments are almost vanishing and the interest rates are coming to very low fixed deposit returns or any other long-term saving products. So I think these kind of products, if it does come as a pension product for the investors, I think it's going to attract a lot of investors because there's going to be a minimum assurance of returns, and investors are looking for this minimum, earning a minimum return from their investment because the scenario we are seeing, everything is variable now.
Okay, all right, Mr. Solanki, many thanks for joining us today on ET Now and just sort of, talking to all of our viewers. Most of them are, of course, having a PF account, subscribers to the EPFO. So
Okay.
I'm sure this is something that has put their worries to rest. All right. Well, you can catch this entire interview on our YouTube channel as well. For now, we will take a very short break. But when we return, it will be time for our Spend with TMS segment where we will be reviewing all of the series of announcements from Apple's events as well as a couple of new gadgets that have recently been launched, whether they are worth your buck. Stay tuned.